Assalamualaikum warahmatullahi wabarakatuh. Today, my group, which is Group 1, will be presenting on capital structure. Before that, let me introduce you to our group members. Our group members consist of 6 people, which is me, myself, Aina Mardia, Irene Sofia, Izzata Atira, Nur Hazira, Nurul Izzah, and last but not least, Muhammad Syahmi. Before we start our presentation, I will invite Syahmi to recite our doa.
Bismillahirrahmanirrahim. Allahumma taf alaina himmataka wa shir alaina min khazain rahmatika ya arhamar rahimin. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Amin.
So, the content that we will cover in this presentation is capital structure, factors affecting capital structure, decision-making process, theories of capital structure, agency problem and cost of equity, signaling hypothesis, and last but not least is the conclusion. Firstly, what is capital structure? Capital structure is about how a company uses a mix of debt and equity to finance its activities and growth. Debt is borrowed money that needs to be paid back, while equity involves selling shares to raise money and gives investors ownership's right. Finding the right balance of debt and equity helps companies fund their operations and grow effectively. There are 2 main components of capital structure, which is debt and equity. Debt refers to the loans or borrowed money. It must be paid back in a set amount of time and usually comes with interest. Equity means money that is raised by selling ownership or shares of the company. People who buy shares become part of the owners and may receive dividends as part of their earnings. Understanding capital structure is important for several reasons. Firstly, it can boost the value of a company's share. Next, proper balance ensures funds are used wisely. Thirdly, it helps improve profits, which can mean higher returns for shareholders. And last but not least, the goal is to maximize the shareholders' wealth while keeping the cost low.
For my part, I will explain about factors that influence company capital structure choice. There are 4 factors which are proportion of tangible assets, size of the firm, profitability, and growth opportunities. Proportion of tangible assets. Tangible assets such as property, plant, equipment, and machinery play a key role in determining the capital structure of a firm. Lenders are more willing to offer debt to firms that have substantial tangible assets. For example, a mining company that owns valuable land, machinery, and equipment is likely to secure debt financing at a lower interest rate because these tangible assets can be used as a collateral. Meanwhile, a software company with minimal physical assets might face higher borrowing costs or may rely more on equity because they have a fewer physical assets to claim in the event of a default. Size of the firm. For example, Microsoft and Apple as large multinational corporations can easily raise capital through issuing bonds at favorable interest rate because they have a strong track record of stable revenues and a diversified business model. Meanwhile, a small startup such as a new online retailer may struggle to issue bonds and may instead seek funding through venture capital or equity financing as it has limited assets and a high risk profile. Profitability. Firms with high profitability are able to retain earnings. For example, Coca-Cola can fund its expansion and operation primarily through retained earnings or by issuing debt, since it is less risky. Meanwhile, a startup or a company with volatile earnings such as biotech firm that's early stage of drug development may need to rely more heavily on equity financing because it might not have enough consistent cash flow to service debt. The last one is growth opportunity. So, for example, a technology startup like Tesla in early stage might prefer to issue equity rather than debt to finance its operation and growth as the company is in a high risk. And for example, the second one is Duke Energy, which operate in a regulated and relatively stable industry, may have fewer growth opportunities but a steady cash flows, allowing it to issue debt more easily at a lower cost.
Company make decision regarding its capital structure by crafting a company capital structure, which is mix of debt and equity. The mix of debt and equity will be used to fund company activity, while for a proportion of debt and equity is employed to finance its operation and investment. The main purpose of capital structure is to balancing on a company financial risk. The consideration and objective that drive the decision-making process is to minimize the cost of capital while maximum shareholder value of WACC. It is also involve considerations such as the cost of capital and market condition. The company required to develop clear decision-making frame. This is important to guide the management to deal with different liquidity. Capital structure decision is a reaction to a change in the condition. First, assess current financial situation. Companies start analyze their financial health, including current liability, existing asset and equity. This helps to maintain the balance between debt and equity financing. Second is risk. A company tolerance for risk affects its capital structure. Higher debt level can increase the return, but at the same time increase financial risk. Larger companies tend to have a higher risk tolerance compared to smaller companies. Companies with a low risk profile might be comfortable with conservative capital structure with a lower debt to equity ratio. Too much debt can lead to financial distress. Third, cost of capital. Company aims to minimize their overall cost of capital. Debt financing is cheaper than equity because tax benefit. Interest payments are tax deductible, but it's come with repayment obligation. Equity doesn't require regular repayment but might be more expensive due to higher expected return by investor.
Assalamualaikum warahmatullahi wabarakatuh. So my name is Nurisa binti Rizwan. I will proceed with the theories of capital structure. So the first one is Modigliani-Miller theory, which is M&M theory. The M&M theory proposed by Frankel, Modigliani and Maitland Miller suggests that under certain condition, the value of a firm is unaffected by how it is financed. This means the firm value is the same whether it is financed by equity, debt or combination of both. Second one is trade-off theory. The trade-off theory proposed that companies balance the tax benefits of additional debt since interest is tax deductible against the cost of potential financial distress, which is bankruptcy costs. The third one is market timing theory. The market timing theory posits that firms adjust their capital structure based on market condition. Companies will issue equity when stock prices are high and optional for debt when stock prices are low. So for the Gamuda Berhad, a Malaysia-based investment holding company engaged in civil engineering, infrastructure and township development. When it comes to their capital structure, they likely consider several theories to optimize their mix of debt and equity financing. So the first one is trade-off theory. Gamuda might use this theory to balance the tax benefits of debt with the cost of potential financial distress. For instance, they might take on moderate debt to benefit from tax savings while avoiding excessive debt to prevent financial distress. Also, Gamuda may adjust their capital structure based on market condition, issuing equity when stock prices are high and opting for debt when stock prices are low. This flexibility allows them to optimize their financing costs.
Next, for my part, I will explain about agency problem and cost of equity. Agency problem is a conflict of interest between a company's management and the shareholder. For the example case, the Boeing buyback and the collapse of Enron are two more well-known instances that are discussed. The Massive Energy Corporation, which is Enron, went bankrupt in 2001 due to fraudulent accounting reports. The company officers and board of directors were both selling the stock for more money. Next is for cost of equity. Cost of equity is the return a business needs to determine whether an investment satisfies capital return criteria or not. It represents the compensation that the market demands in exchange for owning the asset and bearing the risk of ownership. For example, Iskandar Company has trading at 5 ringgit per share with dividend of 50 cents per share and a dividend growth rate of 2% and has a cost of equity of 12%.
Hello and hi, my name is Muhammad Syami bin Muhammad Kamal. Thanks to IS, talk about agency, problems and cost of equity. So right now, I will share my parts about settling hypothesis. But what is settling hypothesis? So definition, settling hypothesis is the idea that a company financial decision like issuing debt or equity send signal to investor about the company. Confidence, it is a financial health and future growth. So this because the company management know more about the company through financial health than outside investor do. Right now, I will tell you about debt and equity signal. For issuing debt, signal confidence in future profits as a positive. Example, borrowing money, debt. If a company decide to borrow money instead of selling more share, it's like the company say, we are confident we can make enough profit in the future to pay back its loan. Investors often see this as a positive sign because it suggests the company is stable and growing. So right now we go to issuing equity. May signal caution or lower ground expectation. Selling new share equity. On the other hand, if the company sell more of its share instead borrowing, it might be seen as less confident about future profit or wasting to raise money without taking out debt. Investors sometimes take this a caution signal, thinking the company might be facing uncertainty or lower growth. Right now, I will give you for the example company like Telecom Malaysia Berhad, or we call TM. A leading provider of telecom Malaysia service in Malaysia. He used debt issuing to expand its internet network, such as the high-speed broadband HSBB project. When TM took his step, it sent a signal that they are confident about their future cash flow, especially because of the increasing need for internet access in Malaysia. In this case, TM is signaling to investors that they are confident they can generate enough profit to repay the debt used for the purpose in the largest investment, making the debt issue a signal of confidence in their long-term prospect.
So the conclusion for theories of capital structure, which is guide companies in making informed decision about financing, balancing benefits and risks, and maintaining financial stability and performance. Each theory offers unique insight that help firms optimize their capital mix, aligning with their strategic goals and market condition. That's all from me. Thank you.